Depreciation affects every stage of the automotive industry, from OEMs planning future models, customers driving a new car out of the dealership for the first time, as well as businesses devising their fleet strategies. But how is this depreciation calculated? Where does this tie into residual values? And what makes this such a crucial topic? Put simply, depreciation is the decrease in a car's value over time. You can calculate a car's depreciation by taking its new price and subtracting the absolute residual value, which is how much the car is worth after a certain amount of time and mileage. For example, a car that costs €40,000 brand new and holds a residual value of €18,000 after 3 years would have a depreciation of €22,000 or 55% of its list price. It's important to note that the rate of a car's depreciation is not linear. Cars depreciate much quicker in the years immediately following registration, and this rate of depreciation becomes slower over time. However, depreciation rates are not the same for all cars. Factors such as age, mileage, powertrain, competitors, condition, service history, reliability, warranty length, fuel economy, owners, and volume can all affect a car's depreciation. Understanding depreciation benefits both sellers and buyers. Sellers better understand potential financial risks. This is useful for OEMs as well as fleet, leasing, and finance companies, because they want to know where the biggest depreciation is happening, in turn minimizing their financial losses. Meanwhile, buyers who focus on cars with lower depreciation rates will be less likely to take on greater financial risk and can get more money if they decide to sell the vehicle. For example, suppose you have two compact crossover SUVs, with one mainstream model and the other in the premium segment. The premium model has a cost new price of €55,900. After 2 years and 40,000 kilometers, it holds a strong percentage residual value of 58.4%, or €32,650 in absolute terms. Meanwhile, the mainstream model has a much lower list price of €43,050, but also retains less value at 49.8%, or €21,450 with the same distance and time scenario. While the premium model loses €23,250 after 2 years, the mainstream model loses only €21,600. So even if the premium car's percentage or absolute residual value is better, you would still have a bigger depreciation loss compared to the mainstream model. However, if the mainstream model had a worse rate of value retention, it could indicate that there is a desirability issue. A model with poor percentage residual value can have a low depreciation, but it also means nobody wants to buy it. So how is depreciation used by different companies? OEMs carry out calculations such as comparing the depreciation of one of their more luxurious models to a compact car, or comparing their model to one of its competitors. However, this doesn't always give them the full picture, as the two vehicles may have vastly different production costs. Depreciation is also vital for fleet and leasing companies, as it helps them to compose their fleet to have the lowest depreciation and financial loss as possible. Just like fleets, finance companies and banks closely track residual values. Because a vehicle acts as a security, accurate depreciation forecasts help them assess risks and prices accordingly, through interest rates and risk premiums. In summary, depreciation is the counterpart to residual values. It gives another lens on used car performance, depending on the strategic focus of the company or individual looking at it. Don't forget to visit the Autovista24 YouTube channel and like and subscribe to stay up to date with all of our content, including our launch report series, webinar recordings, and our What Is Explainer series. You can also visit autovista24.com to find out the latest analysis on the automotive market and scroll to the bottom of the homepage to sign up for our free daily email. Thanks very much for watching.